You are now listening to E4 Bizlosophy, the podcast that guides you on creating abundant wealth and leaving impactful legacies by putting your business in a winning position. Welcome to the journey. I'm your host, Tira D, with my special co-host, Dr. Curtis C. Cochran, aka Doc C. Thank you for joining us. How are you?
I'm doing great. Good afternoon.
Good afternoon. So the title of today's episode is The Ultimate Tax Shelter, Owning Your Own Business. And we're talking about business ownership as a tax shelter. Now, I don't know much about this topic, so I'm relying on you, the expert, to help guide me through this one. So because you're yet another one of your titles is you're a certified professional accountant as well. So you're quote unquote up on game, as they say.
Well, it's actually certified tax and financial planner, but I don't consider myself. I always have to tell people I'm not a CPA, nor would I want to be a CPA. So, but I do know a lot about the tax and tax law, especially for small businesses, for sure.
Okay, so again, say what the title is that you hold again, because I got that completely wrong.
That's all right. It's called certified tax and financial planning. I'm certified in doing that. Again, even though it does have the word tax and planning in it, I still have to disclose the fact that I'm not a licensed CPA. And I always tell my clients or even my colleagues or small business owners that always consult their CPA, their local CPA for information, or at least to make sure that a lot of the information that I'm telling them is accurate. And so that's what I always have to disclose that to the viewers.
Yeah, and that's good business advice also, just to consult your, hired professional, for their advice, even though you're a professional in so many different areas.
Yeah.
So I wanted to break that down a bit for our listeners. First of all, let's clarify what a tax shelter is. And there are so many variable definitions out there depending on who you ask or where you look. But essentially, the way I understand it is a tax shelter is a way of reducing a person's taxable income or tax liability. So when we talk about tax shelters in business, we're referring to reducing your company's taxable income. Is that correct?
Yeah, that's correct. And what small business, I tell you, and I'll go through the data here in just a second, but because more and more people are getting into a small business. Actually, I think it's like 51 or 52% of all the small businesses in the United States are home-based businesses now, due to COVID and in the pandemic, which is really excellent because it's what you just said, and what you can do is being a tax shelter. You're actually lowering your tax liability, running your life, so to speak, through your business. And the IRS, they know this. They know that small businesses operate that way, because that's what our tax law says. Is to lower your tax liability as much as you can. And that's every U.S. citizen, or for that matter, anybody that works in the United States. That's their right to do so.
Right. So, since the Tax Cuts and Jobs Act of 2017 significantly reduced the number of deductions available to employees, lots of people turn to business ownership as a more attractive option. And as you mentioned just previously, although the pandemic greatly affected existing small business
Sure.
owners, sorry,
Yeah.
according to the Census Bureau, more than 4.4 million new businesses were created in the US during 2020, which is the highest total on record. And that's a 24.3% increase from 2019 and 51% higher than the 2010 to 2019 average.
Yeah. I believe that. That's actually good. It's especially, I don't know, what do we call those, Dara? The 18 to 25. What I'm a baby boomer, and I don't know exactly what are they the X generation, Z generation, or I don't know what they are.
Yeah, I'm not familiar with the generations.
Yeah, I don't know, but I do know this after. Yeah, X is extra, and for those of you that are in that category, forgive me if I got your label incorrect. But I after reading a book on these different generations, the baby boomers, we, it was just let's work, get up and work from 7 to 7. I mean, that was, we were trained, our parents actually said, you're going to get out there and work. But things have changed, and they've changed to the point where these kids, I call them kids, this generation, they don't necessarily want to work as hard as the baby boomers. Nothing wrong with that, because the technology has allowed them not have to do the physical labor of the 8 to 5 job as much as we did. And so, what they're doing is, and I just saw in this book, and I wish I remembered the book I was reading. I don't have it with me, but there was a picture of a gentleman, a young kid. He's probably 22, 23. And it showed one picture of the millionaire baby boomer, which is going to his office with a suit and tie and working and da-da-da. And then the other picture showed a 22-year-old that just got out of bed and got on the computer making millions. So it's just a different environment, totally different way of doing things. And technology has, of course, allowed us to open up businesses and online businesses. And I mean, look at Amazon and look at all of these other things that are going on. So, but it's great to hear that the small business community, so to speak, has grown, because for so many years I've taught, or at least tried to coach people to actually open up their own business, because it is indeed a tax shelter.
Right, absolutely. Yeah, it's amazing, the opportunity that technology has opened up,
Yeah.
for so many people. And even for, at least in my mind, I'm thinking for people who are disabled, they don't even have to leave their home, to make an income,
Right.
you know. And I think
That's
that's
right.
phenomenal,
Yeah.
and it allows, people to connect in different, in this other, this other way, that's, I think, like I said, it's brilliant,
Yeah, it's really good. I'll tell you, if you don't mind, can I share you my screen? I'll give you some information.
Absolutely, go right ahead.
Okay, let me
Hopefully I got the
show you
technology right and you're able to do that.
exactly. Let's see here. Boom. Can you see my screen right there?
Yes, absolutely, I can see it.
Okay, good. All right. So this first slide is what I want the viewers to take a look at, because this comes from the IRS website. And And people, there's so much misinformation out there with everything, really. So here it says who pays the most and the least amount of taxes in America today. The top 1% of all filers paid nearly 40% of all taxes. These are people that make 500K plus. The top 5% of the filers are 60%, which is 200,000 plus. And then you have the top 10%, which is paid 70% of the tax at 150,000 plus. So what you have is these people that are in the top 1, 5, or 10%, I don't care where you call it or put yourself at. You see, this is why you actually open up your own business, because you could be generating this kind of revenue, okay, and have a tax shelter. So you can show that the IRS that you're actually making minimal dollars. But the point is still the same, is that you look at who's paying the taxes. It is the upper percentage of people that are paying the taxes. Meanwhile, the bottom half of all filers paid only 3% of the tax revenue. See, and a lot of people, they get discouraged and they get to blaming, especially an 8-to-5 job. When they have an 8-to-5 job, gosh, Uncle Sam took out $250 of my taxes, and they over and over complain about that. But what they don't realize, they can break that mold by opening up their own business, and by doing that, they actually have a tax shelter, which is really a tax. They're lowering their tax liability.
Right.
So bottom line, at the very bottom here, clearly the tax the rich is not a new idea, because it's been going on forever, but there's just so much misinformation out there.
Right.
So this comes from the IRS website. The second one, these are some of the things that people need to know. Bank reporting requirements. Now, what a lot of people don't know is that the Biden administration proposal for banks and other financial institutions to report transactions over $600. That was what he was trying to do. But it got killed by we the people. And so it's still $10,000 or more. See, they wanted to drop it to $600 so that two things happen. Number one is the banks would have to just work their tails off reporting any deposit that's $600 or more. And that's just ridiculous. And so the Biden administration is trying to find out, where's all this money? We want to find it. Okay, so we, the people, decided, no, that's not going to happen. So a lot of people, again, I just wanted to tell our viewers that, this is what the Biden administration was trying to do, is lower it. And in fact, already taxing the rich, the wealthy. Okay, but he wanted to go even further down. Okay, that's my point. Capital gains, that second one, the capital gains rates on short-term capital gains are taxed ordinary income rates of 37%. That's in 2021. That's really nothing really new. Capital gains rates long-term, this first bullet, 0% rate applies for individual taxpayers with taxable income up to $40,000. On singles, 54 head of household, or 80,000 for joint returns. Now, a 15% rate applies for singles with taxable income above 40,000, above for the head, 50,000, 54,000 for a head of households, and 80,800 for couples. And then a 20% tax rate applies for singles with income above 445,000. So you can see that the percentages increase, obviously, to the rich. So we are taxing the rich, bottom line. This is all again from the IRS code. Cash. Now, when we start talking about, you and I talking about opening up your own business, the cash method of accounting, which is the top one up here on my screen, may now be used by more companies in 2020. C corporation with an average annual of 26 million and so forth and so on. So the cash method, instead of the crew, the cash method is of choice. Now, what that really means, because when you open up your own small business, you're going to do the cash method, not the accrual method. The accrual method is more for the corporations. But see, notice that they're allowing the C corporations and other corporations, LLC, to actually, that are making 26 million below, can actually do the cash method. Cash donations, charity up to $600 are deductible on 2021. These are the things that you want to do. So you run your business, everything through your business. For example, and I think that you mentioned that earlier that you started a staging business. Is that correct? You're up and running on that?
Yeah, on another episode. Yes, I did mention that.
Excellent. So in that staging business, this is exactly what you want to do, is you want to run your life, because through, your life expenses through your business, because you are your business. If you're a staging business, and whoever you talk to, real estate agents or homeowners and that want to sell or whatever that might be, those are write-offs, whether it's fuel, whether it's vehicle repairs, those kinds of things. And we'll talk more about that on a different podcast than this one, because that would take some time to do that. So let me move a little bit further down into my slides. The child, that's fine. This is a new one, this cryptocurrency. The cryptocurrency, the IRS is cracking down on reporting requirements for owners of digital currency due primarily to tax evasion. So what's happening with this crypto is that, just like everything else, is that money's being exchanged, but nobody's being accountable for it. Right. So what's happening here is that if you take a look at that third paragraph, it says, here are the reporting rules if you have an overseas account, not just for crypto, but also for any other financial assets. If you are a U.S. citizen with foreign accounts whose total value exceeds $10,000 at any time, you are required to submit an electronic form called the FinCEN Form 114. It's kind of interesting, but you have to, of course, send that form in by April 15, 2022. Now, this last sentence is really important, because it says penalties for non-compliance are stiff. And what that word stiff means is that there's no cap. They haven't figured out what the fine will be if you do not report it. So it could be extensive, and we don't know what that is. And we, the people that analyze the taxes each and every year, we ask the questions, we try to figure out what's going on. Well, the IRS hasn't told us anything about how stiff that might be. So if you are dealing with cryptocurrency, you got to be careful to report those. That's why I put this on today's podcast for sure, because I know a lot of people out there are dealing in cryptocurrency. Absolutely. This is the 2021 tax bracket. This gives you an idea of where you're at if you're married, the dollars that you, for example, if you're married and let's say right here, you're making over $172,750, but no more than $329. Well, you're immediately taxed at $29,502 plus 24%. Wow. Then it is excess over 172. See, a lot of people don't understand how taxes are broken down. This right here is how it's broken down. This shows you wherever you're at. If you're single and you made 40,000, right down here, 40,000 to 86,000, you will pay $4,664 straight out the top. And then you'll pay 22% anything over that 40,000, you see. Now, here's what owning your own business, this is what it means, is see, you actually are going to pay 4,664. Let's say that we're talking about you made 50,000, let's say. So if you made 50,000, you're going to pay at least $4,664 plus that 22% of what, maybe $9,475. Right. So what you're trying to do is take and knock down this 4,664, you see. So now let's say that you own a business, but you also work an 8 to 5 job. And this is what I tell people all the time. If you work an 8 to 5 job, you can have a side business. And the reason why you want a side business is because what your employer is going to be doing is he or she's going to take taxes out every 2 weeks or every month, however they do that. So you're going to be paying Uncle Sam throughout the year. And if you have an 8 to 5 job, 9 chances out of 10, if you're in this bracket, you're going to pay more than $4,664 throughout the year. That's a guarantee. That's why the IRS and a lot of people get a refund, because immediately when they know that you're in this tax bracket, and I'm just again on the 40,525 to 86,375, is they know throughout the year they're going to collect $4,664 from you, at least that, right? We're not talking about bonuses and all these other things that come into play. So what you actually want to do is open up a side business, and the IRS, they don't really frown on the fact that you open up a side business and you're writing off things, because you're already giving them money as like a subscription business. You're giving them money each and every month or every 2 weeks of your money, and they get to play with your money for a year, 12 months.
Yeah.
And then you come back and you're battling Uncle Sam for a tax refund. And so that's how the game is played. You figure out where you are. If you have an 8 to 5 job, where you're at within this scale here. Right. And then you start your own side business and you start to lower your tax liability, which is really what we're talking about, tax shelter. And if you don't have an 8 to 5 job, then you're looking at a P&L statement, which is a profit and loss statement. So you're going to show your P&L, you're going to write off everything, your car and everything. So if you're making, like, say, 150,000 in sales, I'm just throwing that number out there, and maybe your net income from there before you start to write things off is 60 grand. Let's say you made 60 grand, but you start writing off all the legal things that you can write off, which again, we'll go through that on a different show. But once you do that, you do those kinds of things, then at the very end, you're going to show IRS that you made, 12 grand. So then you're taxed on that 12 grand, you see. So that's the difference between whether you own a business outright and you're working the business, or you actually you're working for somebody, an 8 to 5 job, and then you try to do, lower your tax liability. The next slide there is, I forgot to post that, as well as the heads of household. So this is the same breakdown. One of the things that taxpayers need to know is the tax form 1040 for 2021 will look very much like 2020, but schedules 1, 2, and 3 will be much longer, which really means what that means is that IRS wants to know a little bit more about what you are doing. That's exactly what that means. It used to be, it had, one sheet, but now it's much longer, because they want the line items that you put in. They want them explained, so to speak. Why? Because of that statistic that you just talked about earlier, which is, 50 some percent are in the small business. And that's this, I think this is my last screen. I know I've been talking a lot here, and
That's
and
a
um,
lot of
and
information.
yeah, and that's what I'm saying is, I've just been through 4, 5, 6 slides, and this next podcast, and tell our viewers that we'll dive into what write-offs are and what can be legally written off and so forth and so on. And then I'll also show a good online website that you can actually go to that makes your life a heck of a lot easier. But this last slide, consider these census, which you were talked a little bit about. That small business in the U.S. totals some 30 million and growing, which you mentioned. Of those, 53% are home-based, and that's what we, I mentioned. I think I said 51 or 52%, but it's actually 53%. Small businesses make up more than 99.7% of all employers nationwide, which is amazing. Small businesses employ about 50% of all private sector workers. One of the things that people hear of, they hear Amazon, they hear of Google, they hear, but there's small businesses everywhere. It's the heart of America, and that's why I encourage people to dive into the small business world. Small businesses create 75% of new jobs in the national economy. 75% of new jobs. See, that's why the government and the IRS, they really are partners in this whole thing, because they want people to work. They want, so they really kind of put this tax law to favor the small businesses. Why? Because look at the data. The data support the fact that we're a working economy, and we want to work. We want to provide for our families. We want opportunities, and fill in the blank. 3 years after startup, 70% of all small businesses remain open. Now that statistic is amazing, because usually within that period of time, 95% fail.
Right.
But they're saying 3 years. Now they didn't put the 5-year mark on there, because 5 years is important to see, because a lot of businesses struggle within those first 3 years. They don't have the capital to go to year 4 or 5. And that's why, the 3 years, I like that number, because from first 3 years you're in business, you're meeting the stat there. You're 70% will indeed make it. Now, this is my last screen, and then I'll be quiet, I promise. But this says, welcome to the 10% club. Now, what that means is, congratulations on being the 10% club. Everybody thinks they are paying too much in taxes, yet fewer than 10% will do anything about it. I'll say that again. Fewer than 10% will do anything about it. Isn't that alarming? It's just alarming to me. Because what we're doing with our podcast here is really encouraging people to start their own business, open up their own business, run their own business. In other words, take control over their life. That's what this Welcome to 10% Club is all about. And I don't want to necessarily read all of that. I'm sure the viewers will read it. But the very bottom, I want to point out the 3 main reasons why people don't want to join this 10% club is the fear of the IRS, fear of the time it will take to keep detailed records, and not fully understanding what deductions are legal. Now, the next podcast that we do, what I recommend that we actually do is dive in to these deductions that we're talking about, and the website and all these other things. And I think that if we do that here, I think that our viewers will actually, really uh, dive into a business themselves. I think that it'll encourage them to do that, become educated, so to speak.
Absolutely. And I want to say that, all of these things for the people that are just listening and not, watching the podcast, I will make a link available to the slides that Dr. Cochran has shared, so that you have access to those. We'll make a link available. And I'll get the information about the book that, he was speaking about earlier, if he, can remember what it was. And I'll make a link for that as well. So all of this information will be available to you. Yeah, so that was a whole lot of information, a whole lot of great information. I learned a lot of, things that I had no idea about. Again, I, you know, am very limited on my knowledge as far as, taxes, tax shelters is concerned. So again, I appreciate you, sharing all of that information with us today.
Yeah, I'll tell you, I want to give a shout out to a colleague of mine. His name's Dr. Ron Mueller.
Okay.
A lot of the information, and we can give him, give our clients, our podcast people, his information too, because he's been studying taxes forever, for 35 plus years, and a lot of the information that I have gathered over the years is really a tribute to his research. And so we will get that information out to our viewers as well, because he's quite amazing.
Great. Yeah. Maybe next time as we dive into it, maybe we can have him on as a special guest, and we can collaborate with him. And
that would be excellent if he could jump on here. I know he's a busy young man. He's actually out of San Diego, but he's helped me a lot through this whole thing. The more that you dive into small business and taxes and understanding corporations and all of these things, really the better off you'll be in the long run. Don't allow anybody, even your CPA. I don't want to not talk negative to any CPAs or anything like that, but they're in the world of taxes. They prepare taxes and send them to the IRS and so forth and so on. But what people need to understand is that how do you run a business with taxes? And that's what we're going to be talking about. Is we're going to be showing you how to deduct things from your business to actually help it not only grow, but also, again, lower your tax liability, for sure.
Right. And so, there were a couple more questions that I wanted to kind of throw out there, and we're kind of limited on time, but so there's several legal tax shelters that are out there, and some naturally come with more risk, and then some are legal and some are illegal. But of course, we want to encourage that everyone stick to the ones that are legal. So would you say that
legal's good?
Yeah, legal is very good. So would you say that business ownership is one of the safest and least complex tax shelters that are out there?
Yeah, I tell you, you are right. There's several different tax shelters, and of course, if you have dollars, you put into an IRA or retirement savings, and all those things. And of course, you can have those kinds of things through your employer if you're working an 8-to-5 job. But really, I'll tell you what, the business, just opening and running your own business, is going to give you more control over your financial educational IQ. If I even said that right, because you become smarter by running your own business and knowing how money works. And that's why, you open a small business. And we talked about this on an earlier podcast where you asked me, about how should somebody open up their own business. And I said, the first thing you ought to look at is Are you passionate about it? And the reason why you want to make sure that you're passionate about your business is because you're going to be working 24/7. And so you better love what you do, and in which I do. So I don't even think that there's a day that goes by that I feel like I'm working, because I'm helping people, I'm helping businesses buy and sell, mergers and acquisitions, and all these things that I do. And I love the numbers. I love the culture aspect of it. I love dealing with humans, which is really kind of crazy because we're crazy. But the point is, to your question, to be more direct, is that, when you open up your own business, you already have propelled yourself into a new setting of IQ, financial IQ. And that is when we start to deal with the taxes and the deductions and all of these things that you and I will talk about in the next podcast. Right. You will become more educated, and you'll be more confident knowing that you're not going to be afraid of the IRS. Believe me, I've sat across the table with the IRS, questioning even my own, write-offs and the things that I did in my own business. And they're people just like you and I. They're just asking specific questions. And by the way, for our viewers, if indeed you ever get audited, ever, you just have to remember that the IRS will send you a letter, and they have to specify why they're questioning your tax return in writing. They have to go to the line items, and that's why that 1040 is a little bit longer, because now we have more line items that they have to look at. So it's interesting how that runs parallel to audits. And I said one last thing. I lied, because there's one more thing when it comes to audits, that there's 2 to 3% of the IRS can audit tax returns. So already you're ahead of the game. You're betting that 95, 96, 97% of the tax returns are not going to get an audit. Now, not to say, I'm not saying to promote you to do illegal stuff, like we said. What I'm promoting is that you be aggressive with those deductions, because it's your money, not the IRS's money. It's your money. And so you be aggressive. And if the IRS says, no, I'm not going to allow you to do that, okay, you just write them a check for $200, $300, $400, $500 and move on to the next year. That's it. Right. So anyway, that was it. Deal with the audits.
Good information again. So just here's a direct quote that I read in the article, and it says, your business doesn't have to make a profit for your expenses to be deductible. And maybe this is something we'll talk about in more detail in the next episode again, since we'll be talking about tax deductions. And it says, all you have to do is establish a profit motive. And I like that word motive, that it was used there. But can you go into profit motive a bit more into detail and give us an idea of what they mean by that?
Absolutely. What the IRS really means is your intent. Mm-hmm. What is your intent? And your intent is to make a profit. If your intent is to make a profit, then we're going to allow your deduction. Okay, because a lot of people, what happens is they try to write off hobbies, and IRS frowns on hobbies. I like riding horses, so I'm going to write off my saddle. I'm going to write off my, my feed, and I'm going to write off all that, because that's my hobby. But that's not an intent to profit, unless you are showing that you are charging people to ride your horse. You're going to train people how to ride horses, and your intent is to make money using your horse and your saddle and the feed and the stable and all of those things. Yeah. So as long as the IRS sees that you are trying to make a profit, then they'll allow all those write-offs. Now, I will say this, that you want to make sure that you're showing this intent to make money, but you're trying to make money year 4, year 5. So maybe the first 3 years, the IRS says, oh, okay, you lost $1,000 in year 1, you lost $2,500 in year 2, and you lost $3,000 in year 3. But and that could be flip-flopped. But year 4, you should be making money, and that's why I go back to the stat that I have up here, where I was talking. Let me see here. Let me go back to the previous screen here. Yeah. 3 years after startup, 70% are still alive and well. That's why the IRS is thinking that if you're in that 70% and you're alive and well, then year 4 and 5, you should be making money. And so yeah, be careful on that part. But again, the IRS is not going to frown if you're still losing money, as long as your intent is to profit. And that's the big one. You have to show the IRS that you have an intent to make money.
Okay, great. So you spoke a little bit also about, having a hobby and turning it into, or something that you're really skilled in, and turning it into a full-fledged business. What would you say is the best structure for a small business in terms of tax liability?
Structure.
The structure.
Now, when you say structure,
right, and so like an LLC, a sole proprietorship, structures like that.
What I would do is I would make sure that you understand what business you're going to run, and figure out is your tax liability or even lawsuit liability, where's it at? And because a lot of people can actually start their own business as a sole proprietor. A popular one is network marketing companies. Network marketing companies, they're extremely popular, and they're extremely can be extremely lucrative, and they provide a tax shelter because your intent is to try to make money, and your liability isn't really too much there, because you're actually a distributor for MLM company that they have all the appropriate insurances and so forth. So your law liability, so to speak, is not high. But if you do decide that you want to go into a corporation, I'd do an LLC, because it works the same way as a sole proprietor as far as taxes. It whatever you make or you do not make, it runs right through to your personal tax. So that's the best one. You go with an LLC. Now, as you grow, if you grow and you start hiring employees and you start, having machinery and all these other things, then maybe a C Corp or an S Corp would be a way to go. But for right now, LLC is fine. Yeah.
Yeah, I realize that that's a kind of complicated question, because it really depends on, what type of business, you're going to go into and what things are involved. But I was just thinking for, just in general, if you're going to go into
right
a small business, what would be the best, structure? So thanks for
and I'll tell and I'll tell you, and one thing that you and I will both agree on this, that again, we're not CPAs, nor are we attorneys. So if you have a business attorney, you could ask them, and they would actually recommend either. They probably recommend the LLC as well. But again, always consult your local professionals for any kind of, whether it's tax or law advice, all the time, and because they're the ones that are behind the scenes, that are doing the number crunching or the litigation of law. So always consult them.
Yeah, absolutely. I agree with that wholeheartedly. So how does
Yeah.
one, and we've got to kind of wrap up because we've gone, maybe beyond what we thought we'd go with the
Oh,
episode.
yeah.
So how does, one last question from me, and
Sure.
maybe these other questions we can ask on our next episode because it has more to do with the deductions. But are there any tax strategies or well, let's simplify that. Are there any tax strategies that you can offer small businesses out there? And again, maybe this is a question we should ask on our next show.
It's a great segue to our next show because to answer your question is there's several, and what I would tell our audience is to zoom in, chime in, however you want to say it, to our next episode, because we'll go into a couple things. Actually, we'll go into what you can write off, tax strategies for small business. And I'll also show you a nice website. It's a great website. I can't remember. I think it's called Hub something. I can't remember exactly what it is, but I will show you and demonstrate how easy it is to use. And these people that are afraid of going to they're afraid of the IRS, and the second bullet was they're afraid of the time that it takes to actually record everything. It isn't. And you want to record everything so that when the IRS comes in and says, well, what about line item? Well, I have all the paperwork. It's right here. I have all the documentation. And I'm telling you, that's how easy it is. Because the worst thing that could ever happen is if you're writing off something and they disagree, then they bring it back to time zero, which means that they're not allowing you to write it off the $500. It goes back to zero. So what that means is that your tax liability just increases a little bit. So that's it. So they're not going to put handcuffs on you and take you to jail. That's not the way it works. Not unless you commit fraud, but that's not what our program's all about. So the answer to your question is, to our viewers and the people that are listening, please come to the next podcast. Right there is we will go through, it'll probably be a good 30, 45 minutes, bare minimum, to go through all these tax strategies for small businesses. And of course, that website I was mentioning.
Right, absolutely. And Dr. Cochran, as always, thank you for all the information you've provided for us today. And I want to let everyone know that Dr. Cochran will be presenting virtually on the topic of upscaling your business, tackling legal, tax, and funding challenges at the Accounting and Finance Show on December 7th at 1:30 p.m. Pacific Standard Time. And you'll find the link to that information and how to reserve your virtual seat in the show notes, as well as information on how to contact Dr. Cochran should you need any tax assistance for your business. Is there anything else that I missed out, Dr. Cochran?
No, thank you for the shout out. I appreciate that. As always, I enjoy our talks, and can't wait to do our next one for sure.
Yeah, absolutely. Me as well. And we want to thank everyone again, for joining us on yet another episode of E4 Bizlosophy Podcast. We hope that you will not only like and subscribe, but also leave us your comments and let us know how we're doing. And also, if you have any additional questions that either Doxy or I can answer in regards to tax shelters, and then maybe some questions about tax deductions for our next podcast that we can answer. So until next time, thank you for joining us. You have been listening to the E4 Bizlosophy Podcast with Doc C and Tira D. We would like to thank our audience for taking the time out of their busy schedules to listen to our podcast. We hope you will continue to tune in week after week. Please don't forget to follow us on @E4BizPod on the various social networks. And if you've enjoyed our podcast so far, please show us some love by leaving a like, subscribe, comment, or write us a review wherever you get your podcast. Join us again next Friday.